Welcome to Talk Tickers.
I'm great to be here.
So on this deep dive, we are getting into a financial topic that frankly keeps popping up in the earnings calls we summarize every week.
Oh yeah, it is everywhere now.
It really is. We are looking at a market that is arguably the most abstract and yet increasingly the most expensive sector in the global economy.
Abstract is definitely the word for it.
Right, because if you walked onto a trading floor, say 20 years ago, and told people that thin air would be trading at a higher volume than some major agricultural commodities.
You'd have been escorted out of the building.
Exactly. You'd have been sent to the psychiatric ward.
Yeah.
But here we are diving into the carbon asset economy today.
We really need to set the stakes immediately on this one because there is just a massive misconception about what this actually is.
Yeah, when most people hear the phrase carbon markets, they instantly think of environmentalists.
Right. They think of saving the polar bears.
Or that little checkbox on the airline website.
Yeah.
You know, the one where you pay an extra $5 to offset your flight to London?
Which is, a nice sentiment, but that is absolutely not what we are here to discuss today.
No, we are not looking at this through the lens of activism at all.
No.
We are looking at it purely through the lens of capital allocation.
Exactly.
Because we are dealing with a multi-trillion-dollar financial ecosystem here. It has matured into a legitimate asset class.
It really has. And to understand it, you have to look at the numbers because there are really two parallel economies operating at the same time.
It is a tale of two markets.
Totally. On one side, you have the voluntary market. That is the airline checkbox you mentioned earlier.
The corporate social responsibility stuff.
Branding exercises.
Yeah.
And that market right now is valued at roughly $2.5 billion.
$2.5 billion. Okay. I mean, that is significant, but in global finance terms, that is...
It is a rounding error.
Right. It's like a mid-cap tech stock on a bad Tuesday.
Precisely. But then you look at the other side, the compliance market.
This is the mandatory government-regulated sector.
Yes. And that market is valued at over $1.5 trillion.
The spread there is just staggering. 2.5 billion versus 1.5 trillion.
And that 1.5 trillion is where the smart money is actually paying attention right now.
Because this isn't about charity anymore.
Not at all. It is about legal obligations. It's supply and demand mechanics. It's highly sophisticated hedging strategies.
We are basically watching carbon transition from being a regulatory burden, like a fine you just pay for being a dirty company, into a completely idiosyncratic asset class.
And that phrase, idiosyncratic asset class, is so important here.
It sounds like banker speak for an asset that just does its own thing.
That is essentially exactly what it means. It means it is fundamentally uncorrelated to the broader market.
Right, because the price of a carbon allowance is driven by policy decisions.
Policy decisions and industrial output, not necessarily by the same macroeconomic factors that drive the S&P 500 or the bond market.
And in a world where everything seems to be correlated lately.
Where stocks and bonds are just crashing together.
Yeah, finding an asset that marches to the beat of a totally different drum is incredibly valuable for anyone building a portfolio.
It is the holy grail of diversification.
So our mission for this deep dive is to basically unpack this massive machinery.
There is a lot to unpack.
We need to understand the basic mechanics of cap and trade versus the sort of wild west of offsets.
We definitely need to look at the heavyweight champion of this space, which is the EU emissions trading system.
And we have to talk about how companies like Tesla are quite literally printing money using these systems.
Oh, the Tesla angle is fascinating.
Plus, we will look at the future catalysts, specifically this new border tax known as CBAM and the emerging role of blockchain and tokenization.
It is a dense topic, but if you can understand this, you really understand the future of global trade.
So let's start at the bedrock, the terminology. Because I think a lot of listeners, and honestly myself included before digging into this, tend to use the words carbon allowance and carbon credit interchangeably.
Oh, all the time.
It all just sounds like carbon.
Right, but they are fundamentally radically different commodities.
How different?
They are as different as a treasury bond and a donation receipt.
Okay, that is a sharp distinction.
They serve completely different purposes and they originate from completely different places. So let's start with the allowance.
Okay.
The allowance.
In the industry, we often just call this a permit.
Like a permission slip.
Exactly, like a permission slip from the teacher. An allowance is a license to emit exactly 1 metric ton of CO2 equivalent.
And where do these come from? Because they aren't created by planting trees, right?
No, absolutely not. These are issued exclusively by sovereign governments.
So the European Union.
The EU, the state of California, the UK government.
So this is fundamentally a government-created fiat asset.
Correct. And it functions under a system called cap and trade.
Right, cap and trade. We hear that thrown around a lot. How does it actually mechanically work?
So the government sets a ceiling, a hard cap on the absolute total amount of emissions allowed for a specific sector.
Say power generation. Right, let's use power plants. Let's say the cap for the entire country is 100 million tons for the year. The government prints exactly 100 million allowances.
Okay.
Now, if you are a power plant operating in that country and you emit 1 ton of CO2, you must surrender 1 allowance back to the government at the end of the year.
And what happens if you emit a ton, but you don't have an allowance to give them?
You get hit with a massive punitive fine. And the kicker is you still have to go into the market and buy the allowance to cover the shortfall anyway.
Oh, wow. So it isn't optional at all.
No, it is a literal license to operate your business.
So where does the trade part of cap and trade come in?
That happens when companies buy and sell these permits among themselves.
Give me an example.
Sure. So let's say company A is highly efficient. They invested in new tech and they actually cut their emissions way down.
So they have leftover allowances.
Exactly. They have a surplus. Meanwhile, company B is running an old, dirty coal plant and they are blowing past their limits. They desperately need more allowances.
So company A sells their extra permission slips to company B.
Right. And through that transaction, a market price is established for a ton of carbon.
Makes sense. But here is the part that I think makes this a real investment thesis. The cap isn't static, is it?
No. And this is the most critical part to understand. The ceiling lowers.
Every year.
Every single year. The government deliberately removes a fixed percentage of the allowances from the overall system.
So the total supply shrinks automatically.
It is a game of musical chairs, but they are permanently removing a chair after every single round.
And basic economics tells us that if demand remains relatively constant, because society still needs electricity and steel and concrete, but the supply is mathematically guaranteed by law to shrink.
The price has to rise.
It is engineered scarcity.
Completely engineered. It is designed specifically to force innovation. The idea is that eventually the price of the allowance gets so prohibitively high that it is literally cheaper for the company to just build a wind farm than to buy the right to keep running their coal plant.
Okay, so that is the allowance. That is the ticket to emit in the massive compliance market.
Right.
Now let's contrast that with the credit or the offset.
Right. So if the allowance is the permission slip, the credit is the cleanup crew.
The cleanup crew.
A carbon credit represents 1 metric ton of CO2 that has already been removed or avoided somewhere else in the world.
And these do not come from the government.
No, they come from private project developers.
So this is the reforestation project in the Amazon. Or like a methane capture facility at a giant landfill in Texas.
Exactly. When these private projects can prove, or at least claim to prove, that they have reduced emissions, they generate a credit.
And then companies buy these credits.
Yes, they buy them to, quote unquote, compensate for the emissions they haven't been able to eliminate from their own operations yet.
But, and this is a huge distinction I picked up on, in the major compliance markets, you generally cannot use these private voluntary credits to meet your legal government obligations.
Generally, no. You absolutely cannot.
Wait, really? So if I am a German coal plant and I am short on allowances, I can't just go buy a bunch of really cheap forest credits from a project in Brazil to satisfy the EU regulators.
No, the EU regulators would laugh at you. They want you to reduce your actual emissions within the borders of Europe. They do not want you paying someone else to plant a tree on the other side of the planet.
They want the industrial change at home.
Exactly. They have severely restricted and in most cases banned the use of offsets in the compliance market. And that right there is why there is such a massive price discrepancy between the two markets.
Let's break down that price gap because it is wild.
It is. So in the compliance market, let's take the EU ETS, for example. Those government allowances trade in a range of roughly $35 to nearly $100 per ton.
Depending on the year and the macroeconomic conditions.
Right. But in the voluntary market where you are buying offsets, the prices are completely all over the place.
Because of fractured market.
Highly fractured. You can find junk credits from old wind farms trading for under $1.
Under $1.
Yeah, literally pennies. Meanwhile, high-quality engineered removal credits like direct air capture might be $20 or $30. But on average, the voluntary market trades at a massive, massive discount.
Because the quality is highly variable and the demand is completely optional.
Exactly.
It makes total sense. One is a regulatory gun to the head of a corporation, and the other is basically funding a PR campaign.
That is a very cynical way to put it, but honestly, it is an accurate way to put it.
So let's dig deeper into that compliance market, because that is where the real money is, specifically the heavy hitters. Who is actually out there blowing these $100 allowances? Is it just the utility companies?
Well, historically, yes. It started with the power sector because utilities are the easiest entities to regulate. They are stationary, they are massive, and they are heavily metered.
Right. You know exactly what is coming out of the smokestack.
But the net has expanded significantly over the years. We are talking about heavy industry now.
So who else is captured?
Steel manufacturers,
Yep.
cement producers, aluminum fertilizer, paper glass.
So basically the foundational building blocks of the modern economy.
Yes. Highly energy-intensive industries that traditionally operate on very thin margins.
So for a CEO of a massive cement manufacturer, the price of carbon isn't just some abstract environmental concept anymore.
Not at all. It is a major line item on their P&L. It creates a massive carbon liability on their balance sheet.
They do have to hedge it.
They absolutely do. If you are running a steel mill today, you have to forecast the price of carbon 3 years out, just like you have to forecast the price of iron ore or metallurgical coal.
And if your forecasting is wrong.
If you get it wrong and carbon spikes, you go out of business. It is that simple.
So we know the mechanism for pricing on the supply side is the government auction, essentially deciding how many permits to release.
Right.
What drives the demand side on a month-to-month basis? Is it just pure economic growth, like GDP goes up, emissions go up?
Economic growth is the baseline for sure. If factories are running 24/7, they burn more fuel, they need more allowances. That is the macro trend.
But there is more to it.
There is a huge daily variable that traders in this space watch like absolute hawks.
What is that?
The weather.
The weather. You're saying carbon traders are watching the Weather Channel.
They are obsessed with it. Think about the European energy grid for a second. It is a massive complex mix of renewables, nuclear gas, and coal.
Right.
If you get a harsh freezing winter in Northern Europe, heating demand absolutely spikes.
Naturally.
Now, if that cold snap coincides with a period where the wind isn't blowing and the sun isn't shining, what the Germans call a Dunkelflaut.
Oh, I've heard of that. A dark doldrums period?
Exactly. When renewables drop off, that massive heating demand has to be met instantly by spinning up fossil fuel plants, usually coal or gas.
Which means sudden massive emissions.
Which means a sudden massive spike in the demand for allowances, and the price of carbon shoots up.
So carbon is essentially functioning as a derivative of weather patterns.
In the short term, yes, absolutely. A surprise cold snap in Germany can send the global price of carbon rallying.
And the reverse is true.
Completely.
Yes.
A very windy, warm month in the North Sea can crash the carbon price because wind power generates zero carbon, so the utilities don't need to buy any allowances that month.
That is fascinating. It really highlights how dynamic this market is. Which leads us perfectly to the biggest stage for all this drama, the EU emissions trading system, the EU ETS.
The undisputed heavyweight champion of carbon.
Yeah, the research clearly frames it as the gold standard. Why is Europe so far ahead of, say, the US or Asia on this?
Because Europe actually had the political will to start early. They launched the EU ETS way back in 2005.
Wow, almost 20 years ago.
Yeah, it is by far the world's largest and most liquid carbon market. But you know, it wasn't a straight line to success.
No.
No, not at all. We actually have to talk about the massive crash they had because it is a vital lesson in how you design these markets.
You mean the crash around the 2008 financial crisis?
Yes. So when the global financial crisis hit, industrial output across Europe just fell off a cliff.
Factories completely shut down.
Right. Which naturally meant real-world emissions plummeted. But the government had already pre-issued all the allowances for that multi-year trading period based on their old rosy pre-crisis economic growth forecasts.
Oh, I see. So the market was suddenly flooded with millions of permits that nobody actually needed.
Exactly. Supply massively outstripped demand overnight.
What happened to the price?
The price of carbon crashed to near zero. It was literally trading for pennies.
And if the price of polluting is zero,
the market signal is completely dead. If it costs nothing to pollute, there is absolutely zero financial incentive for a company to invest in expensive green technology. The whole system broke.
so how did they fix a broken market?
They realized they needed something akin to a central bank function.
Like the Federal Reserve, but for carbon.
Exactly. They couldn't just have a rigid fixed supply schedule anymore. They introduced a mechanism called the Market Stability Reserve, or the MSR.
I saw this detailed in the deep dive notes. The MSR basically functions like a giant vacuum cleaner.
That is a really good analogy. The MSR automatically monitors the total number of allowances actively circulating in the market.
Okay.
If the surplus gets too high, say because of another recession or say a global pandemic like we saw recently, the MSR automatically activates and vacuums up the excess allowances.
It pulls them out of circulation.
It locks them in a reserve. It artificially tightens the supply to prop the floor price up.
And does it work in reverse? Like if prices get dangerously high?
Yes, it is a two-way valve. If the market gets entirely too tight and prices spike to levels that would literally bankrupt the European industrial base, the MSR can release extra allowances back into the market to cool things down.
So it basically provides a price corridor.
Exactly. It gives long-term investors the confidence that the price won't ever crash to zero again, but it also assures the heavy industries that the price won't shoot to $1,000 overnight and put them all out of business.
It engineered stability.
Yeah.
And what about the actual physical results? Because stability is great for traders, but has it actually lowered real-world emissions?
The data on that is undeniable. In the specific sectors covered by the EU ETS, greenhouse gas emissions actually dropped by 47% by the end of 2024.
Compared to what baseline?
Compared to 2005 levels when the program started.
47% is a massive, massive structural shift.
It is. And crucially, and this is the part economists love, the overall EU economy grew significantly during that exact same 20-year period.
Right, so they achieved the holy grail, decoupling.
Exactly. They proved empirically that you can grow a modern industrial GDP while simultaneously shrinking your emissions if you just price the negative externality correctly.
And because it works so well, they're doubling down now.
Yeah.
The scope of the market is expanding rapidly. I was really surprised to see shipping included as of 2024.
Oh, the maritime inclusion is a huge shift. Shipping logistics has been a free rider on global emissions for decades.
Because it happens in international waters.
Right, out of sight, out of mind. But now, under the new rules, if a massive container ship docks in Rotterdam or Hamburg, it has to surrender carbon allowances for the emissions of its journey.
Which means the cost of shipping a container of sneakers from Shanghai to Europe just went up.
It definitely creates new inflationary pressure on goods, yes. But it also creates a massive financial incentive for giants like Maersk and MSC to finally switch their fleets to green methanol or ammonia fuels.
Because the cost of doing nothing is finally higher than the cost of upgrading.
Exactly. The financial market is doing the heavy lifting that standard environmental regulations just couldn't manage.
And there's a sequel to this coming, right? Something called ETS2. In 2027.
Do CTS2. And this is the one that is going to hit much closer to home for the average citizen in Europe.
Why is that?
Because ETS2 directly covers fuel use in commercial and residential buildings as well as road transport.
So we are talking about heating people's homes and the gas in their cars.
Right. The upstream fuel suppliers are going to have to buy allowances for the carbon content of the fuel they sell.
And obviously they're going to pass that cost straight down to the consumer.
Absolutely. It will show up at the pump and it will show up on the winter heating bill.
That seems incredibly politically risky.
It is intensely politically risky. You are essentially taxing the daily commute. But policymakers argue it is absolutely necessary if they want to hit their legally binding net zero targets by 2050. They have to expand the carbon liability from just the big faceless heavy industries to the broader economy.
This expansion naturally brings us to the core investment case. We have established now that this is a real, heavily regulated, growing market. But why would a regular institutional investor, someone managing a pension fund who doesn't own a steel mill or a power plant, why would they want to just buy and hold these carbon allowances?
It goes right back to that idiosyncratic nature we touched on earlier. Institutional investors are constantly desperately looking for non-correlated assets.
Right, especially after what we saw in recent years.
Exactly. If you look at a year, like 2022 stocks went down hard and bonds went down hard at the exact same time. The traditional 60-40 portfolio offered nowhere to hide.
But carbon is different.
Carbon is driven by regulatory tightening, by law.
The scarcity is mathematically programmed into the system.
Precisely. The supply will go down. It is legally mandated to go down. That creates a structural bullish tailwind that simply doesn't exist in the equity markets. So adding carbon to a broad portfolio actually improves the overall risk-adjusted returns because it tends to zig when the rest of the market zags.
There is also this climate risk hedge argument that I found fascinating. It actually seems pretty intuitive once you think about it.
It is probably the single most compelling argument for bringing institutional capital into this space. Let's walk through it. Say you are managing a massive state pension fund.
Okay, I'm a pension fund manager.
You inherently own a massive slice of the S&P 500 or the global equivalent.
Right, I own the whole market.
Which means you are deeply exposed to oil majors, legacy airlines, chemical companies, heavy manufacturers.
The heavy emitters.
Right. This exposes you to what analysts call transition risk.
Meaning the risk of transitioning to a green economy.
Yes. If government regulations suddenly get much tighter globally and carbon prices soar to, say, $200 a ton, the profit margins of all those dirty companies in your portfolio are going to completely collapse.
Which means my stock portfolio takes a massive hit.
Exactly. You lose billions. So how do you hedge that specific risk?
You buy the carbon allowances.
You buy the carbon. If carbon prices soar, your dirty legacy stocks go down just like you feared, but your physical carbon allowance portfolio goes up exponentially.
They balance each other out.
You have perfectly hedged your portfolio against the green transition. You are covered no matter which way the policy winds blow.
That makes total sense. Now, the research notes also mention something called brown spinning. I love this term. It sounds like an absolute PR disaster.
It is a massive critique of the whole ESG divestment movement.
How so?
So for the last decade, a lot of big funds have made these grand public announcements saying, look how ethical we are. We just sold all of our fossil fuel stocks.
Right. They divest to clean up their image.
Okay, great for your marketing brochure, but who exactly did you sell those oil stocks to?
Somebody bought them.
Exactly. You sold them to a private equity firm or a shadow banking hedge fund that frankly doesn't care at all about public optics or ESG scores.
So the oil company doesn't change.
The oil company is still pumping the exact same amount of oil. The physical emissions entering the atmosphere are identical.
You just spun the brown asset over to a new owner who doesn't care.
Right. You wash your own hands for your shareholders, but you did absolutely nothing to actually clean up the planet. That is brown spinning.
So what is the alternative strategy? How does an investor actually force change?
The alternative is a strategy called top-down decarbonization.
How does that work?
Instead of just passively selling the oil stock, you aggressively step into the compliance market and you buy the actual carbon allowance itself.
And then what? You sell it to the oil company?
Duh.
You sit on it. You just hoard the permit.
You lock it in a vault. Remember, there is a strictly fixed and shrinking number of these allowances in existence. If a massive financial investor buys 1 million allowances and refuses to sell them, that is 1 million fewer allowances physically available for the actual polluters to use.
Wow. You are artificially constraining the supply even further.
Yes. You are literally forcing the industrial market to decarbonize faster because your hoarding is driving the clearing price of carbon up much faster than the government schedule intended.
That is wild. It's like active weaponized impact investing.
It is using the mechanics of capitalism to choke off the emissions.
Now we really cannot talk about capitalizing on carbon credits without talking about Tesla.
Oh, the absolute masterclass in regulatory arbitrage.
The numbers on this are just wild. If you look at 2023 alone, Tesla generated $1.78 billion in pure revenue just from selling regulatory credits.
And you have to remember, the profit margin on that specific revenue stream is essentially 100%.
Right. There's no cost of goods sold on a regulatory credit. It just falls straight down to the bottom line.
It is free cash flow.
Explain the exact mechanism here, because this isn't the EU ETS system we were just talking about, right?
No, this is a slightly different mechanism, largely based on state-level U.S. regulations, primarily California's ZEV mandate.
ZEV being zero-emission vehicle.
Right. So the state government goes to all the major automakers and says, okay, a certain specific percentage of the total cars you sell in our state this year absolutely must be electric.
And for a very long time, legacy players like Ford, GM, Chrysler, they just couldn't meet those targets.
They weren't even close. They were highly profitable, selling massive gas-guzzling pickup trucks and SUVs, so they generated a massive deficit in their required electric vehicle quotas.
But Tesla, on the other hand,
Tesla obviously only sells electric vehicles, so they constantly operate at a massive, massive surplus of these ZEV credits. They have 100% compliance naturally, so every single credit they are allocated is pure excess.
So what happens? The legacy automakers basically have a choice.
They have a stark choice. They can either pay an astronomical punitive fine directly to the state of California, or they can go to Elon Musk and buy his excess credits at a slightly lower price.
And they always choose to pay Tesla.
Because it's just cheaper than the fine. But think about what is functionally happening there. It is a direct mandated wealth transfer from the slow legacy incumbents straight into the pockets of their most dangerous, disruptive competitor.
So GM and Chrysler were literally funding Tesla's factories.
Absolutely. If you look closely at Tesla's financials during their most critical scaling years, they were actually losing money on the physical act of manufacturing and selling cars.
Right, the automotive gross margins were negative for a while.
The only reason they were able to post a net profit and keep Wall Street happy was entirely because of these hundreds of millions of dollars in regulatory credit sales.
That is just brilliant. The regulatory market directly subsidized their survival.
It is the system working exactly as the policymakers originally intended. You brutally punish the laggards who won't adapt, and you aggressively reward the innovators who take the risks.
But logically, this has to be a melting ice cube for Tesla, right? Because as Ford and GM finally ramp up their own EV production, they aren't going to need to buy those credits from Tesla anymore.
That is entirely true. That specific revenue stream will eventually dry up as the rest of the industry achieves compliance. But it already served its historical purpose. It provided billions in free capital during the exact phase when Tesla needed it most.
Okay, let's pivot now. We have spent a lot of time on the compliance market, the serious, heavily regulated, government-enforced, high-dollar stuff.
The real market.
Right. But we need to go back and address the Wild West again, the voluntary market. Why is it such a persistent mess?
Because it fundamentally suffers from what the industry calls an integrity challenge.
Unpack that.
Well, in the compliance market, a ton of carbon is exactly a ton of carbon because the sovereign government explicitly dictates that it is highly audited.
It is a standardized fiat commodity.
Right. But in the voluntary market, a ton of carbon is basically whatever a private project developer claims it is.
And who verifies that claim?
It gets verified by a third-party auditing registry. But, and here is the massive structural flaw, that auditing registry is ultimately paid by the very project developer they are auditing.
Oh, wow. That sounds like a catastrophic conflict of interest just waiting to be exploited.
It introduces an immense amount of noise and low-quality assets into the system, and it leads to massive pricing opacity.
Like we mentioned earlier, some credits are $3, some are $50.
And the market really struggles to figure out which ones actually represent real atmospheric benefits and which ones are just clever accounting tricks.
And that quality assessment really comes down to two specific technical words I kept seeing in the background research: additionality and permanence.
Those are the twin pillars of carbon integrity. If a credit fails either of those tests, it is essentially worthless junk.
Okay, let's start with additionality. What does that actually mean in practice?
It is the hardest thing to prove. To generate a truly valid credit, you as the developer have to conclusively prove that the emission reduction you are claiming would absolutely not have happened anyway without the specific financial incentive of selling the credit.
It is the classic, but for test. But for this money, the good thing wouldn't have happened.
Precisely. Let's run a hypothetical. Say you own a massive, beautiful tract of forest. You use it for hunting, you camp on it, you love it.
Okay.
You never had any intention of cutting those trees down. Ever.
Right.
But a slick carbon developer approaches you and says, hey, just sign this piece of paper legally claiming you were strongly considering clear-cutting this entire forest to sell the lumber. Now we will draw up a contract where you formally agree not to cut it down, and in exchange, we will issue thousands of avoided deforestation carbon credits and sell them to a tech company in Silicon Valley.
Wait, that sounds like outright fraud.
Functionally, it is, because the atmosphere itself sees zero net benefit. The trees were always going to stay there anyway. Nothing actually changed in the physical world.
But money changed hands.
Money changed hands, and some tech giant got to publish a flashy CSR report claiming they legally offset their server farm emissions.
So that credit is non-additional.
Exactly. It is a ghost credit. It did nothing.
That is wild. And what about the other pillar? Permanence.
Permanence is the physical risk side of the equation. We know scientifically that CO2 stays trapped in the atmosphere for centuries.
Right, it's a long-term problem.
So if you plant a sapling today to offset the emissions of your flight to London, you are implicitly betting that that specific tree is going to survive and sequester carbon for the next 100 years.
But forests burn down. especially lately.
That is exactly the problem. We saw this startly with the massive wildfires on the U.S. West Coast recently.
What happened?
Huge buffer pools of voluntary carbon forest projects essentially just went up in smoke. The trees burned, and all the carbon they were supposed to be storing was violently released right back into the atmosphere.
So the physical carbon is back in the air. What happens to the financial credit that some company already bought?
That is the mess. The credit is now physically and environmentally invalid, but the financial transaction closed 3 years ago. The company already claimed the PR win.
So there's a massive delivery risk on nature-based solutions.
Huge. And this is exactly why the voluntary market trades at such a steep discount compared to the compliance market. The institutional buyers simply do not trust the permanence of the asset.
This all naturally leads straight into the endless accusations of greenwashing. And I really want to use this time to clarify the terminology, specifically the difference between being carbon neutral and achieving net zero.
They are completely different paradigms.
Because I feel like corporate marketing departments intentionally use these phrases as synonyms just to confuse consumers. But the experts are very clear that they are distinct.
They are worlds apart in terms of actual climate impact. Carbon neutral is essentially the old, outdated standard.
How does it work?
It basically means you hire a consultant to calculate your company's rough carbon footprint. Then you just go out into the voluntary market and buy enough cheap offsets to mathematically match that number, and boom, you are done.
You can achieve that instantly.
Literally today. You could operate a massive, filthy, coal-fired power plant and legally call yourself carbon neutral tomorrow if you are willing to write a big enough check for dirt-cheap, unverified forestry credits.
This is literally a pay-to-pollute model. You don't have to change your operations at all.
Exactly. Net zero, on the other hand, specifically as defined by the Rigorous Science-Based Targets Initiative, or SBTI, is an entirely different and much stricter beast. It requires a strict hierarchy of physical action. To claim net zero, you must first internally reduce your actual real-world gross emissions by 90 to 95%.
You have to do the hard operational work first.
You have to change your factory light bulbs.
Yeah.
You have to fully electrify your delivery fleet. You have to completely redesign your supply chain to use green steel.
You have to actually lose the weight yourself. You can't just pay someone else to go to the gym for you.
Great analogy. You have to run the marathon. Then, and absolutely only then, once you have reduced everything you possibly can, are you allowed to use offsets to cover that tiny remaining residual 5 or 10% that is technologically impossible to eliminate today.
Like aviation fuel for executives or something.
Right. And even then, you can't use those cheap avoided deforestation credits. You have to use high quality, expensive removal credits like direct air capture, where they actually pull CO2 out of the sky and inject it into rock formations.
So carbon neutral is just writing a cheap check for good PR. Net zero is fundamentally rebuilding your entire core business model.
Correct. And sophisticated investors are really starting to demand true net zero alignment. They completely see through the shiny carbon neutral stickers now. They know that buying $2 forestry credits does not make a heavy industrial company sustainable in the long run.
Now, the sources did mention something called Article 6 of the Paris Agreement that is supposedly trying to clean up this exact mess.
Article 6 is essentially the UN's attempt to finally create a cohesive, standardized, global rule book for carbon trading.
Because right now it is fractured country by country.
Exactly. Article 6 allows sovereign countries to officially trade high-quality credits between themselves to meet their national climate goals.
They're NDCs, right?
Right. They're nationally determined contributions. Ideally, this framework will finally bring the strict auditing rigor of the government compliance markets into the international voluntary trade.
And specifically, it aims to prevent something called double counting.
Oh, double counting is a massive plague on the voluntary market.
Give me an example of how that happens.
Okay, so say a project developer in Brazil creates a carbon credit by protecting a forest, and they sell that credit to a corporation in Germany.
Okay.
Under the old broken system, the government of Brazil looks at that forest and counts that emission reduction towards their own national climate goals.
But the corporation in Germany is also claiming it.
Right. The German company uses it to claim they are carbon neutral.
So it's 1 physical ton of carbon reduced, but 2 separate entities are taking credit for it on paper.
Exactly. It's double counting. Article 6 creates a strict, centralized ledger system to explicitly stop that from happening. Once the credit is sold across borders, a corresponding adjustment is made so only one entity can ever claim it.
Speaking of centralized ledgers, that perfectly segues into the future tech catalysts we need to cover. specifically tokenization.
Right, putting carbon on the blockchain.
And it was really surprising to see major traditional finance players seeming so incredibly bullish on blockchain for this specific use case. Because generally, Wall Street is pretty skeptical of crypto.
They absolutely hate the wild speculation of crypto, but they deeply love the underlying plumbing and infrastructure of blockchain technology.
Why is it so useful here?
Because the voluntary carbon market today is entirely traded over the counter, OTC.
Meaning it's just direct bilateral deals.
Yeah, it is incredibly opaque, illiquid, and ridiculously slow. The entire multi-billion-dollar market basically runs on Excel spreadsheets and PDF certificates emailed back and forth between brokers.
That sounds ancient. So how does tokenization fix that?
Tokenization immediately solves the transparency and double counting issues. If a carbon credit is minted as a unique token on a public blockchain, you can trace its entire life cycle instantly.
You see the exact provenance?
You see exactly when the project generated it, who audited it every single time it changed hands, and crucially, you see exactly when it was permanently retired.
Let's define that term. Retired just means the credit was finally used, right?
Yes. Once a company formally uses a credit to offset their annual emissions, that specific credit must be retired from the system so it can never be sold or used again.
Like punching a ticket at the movie theater.
Exactly. And blockchain makes that retirement event cryptographically immutable. You literally cannot double spend a retired carbon token.
And the research also highlighted this concept of composability, which honestly sounds like a hardcore decentralized finance term.
It is a pure DeFi term. It means that once the carbon is a digital token, you can easily bundle it and integrate it into other complex financial products, just like Lego blocks.
Give me a hypothetical example.
Imagine launching a green Bitcoin ETF or a carbon neutral gold fund. You could program smart contracts into the fund so that every single time a trade executes, a tiny fraction of a penny is automatically routed to buy and permanently retire a fraction of a tokenized carbon credit.
Wow. So you're essentially automating the ESG conscience of the entire financial market.
You are building automated sustainability directly into the core plumbing of the global financial system.
That is genuinely fascinating. But as we discussed earlier with additionality garbage in, garbage out, right? If you just tokenize a fraudulent, low-quality forestry credit,
you just end up with a highly transparent digital token of a terrible asset.
the blockchain doesn't magically make the tree real.
No, the blockchain only flawlessly validates the financial transaction. It cannot validate the physical quality of the forest canopy in Brazil. You still absolutely need geologists and ecologists on the ground checking the physical reality.
Let's move to the final and perhaps the most explosive catalyst we are tracking. CBAM.
The Carbon Border Adjustment Mechanism.
This sounds like a massive geopolitical trade war just waiting to happen.
It is, without exaggeration, arguably the most significant structural change in global trade policy since the World Trade Organization was formed.
Really? That big?
It is a massive carbon tariff.
Okay, let's break it down. What specific structural problem is CBAM designed to solve?
It is designed to solve a phenomenon called carbon leakage.
Carbon leakage. Explain that.
For years, European heavy manufacturers have been screaming at regulators in Brussels, saying, look, this is entirely unfair. We are legally forced by the EU ETS to pay 80 euros a ton for our carbon emissions.
Right? Their costs are skyrocketing.
But our direct competitors producing steel in China or India or Turkey currently pay absolutely nothing for their carbon emissions.
Because their home countries don't have an ETS.
Right. So the foreign producers can easily dump much cheaper dirty steel into the European market and completely undercut domestic manufacturers.
So the European factories just threaten to close down and physically relocate their operations to those dirty jurisdictions.
Exactly. And if a steel plant moves from Germany to India, you haven't actually reduced global emissions at all. You just exported the pollution and lost the local jobs. That is carbon leakage.
So how does CBAM actually stop that?
CBAM changes the rules of the border. The EU is basically saying, fine, if you want the privilege of importing your steel or cement or aluminum or fertilizer into the lucrative European single market, you have to pay a toll.
And what is the toll?
You have to pay the exact mathematical difference between whatever carbon price you paid in your home country and the current clearing price of carbon inside the EU ETS.
Wow. So if I own a massive Turkish steel mill, and my local government charges me zero carbon tax,
you have to pay the full 80 euro per ton EU carbon price at the border before your steel is allowed off the ship.
That is incredibly aggressive. So the EU is effectively acting as the world's unilateral climate policeman. They are exporting their internal domestic regulations to the rest of the planet.
Absolutely. And it fundamentally changes the macroeconomic calculus for every manufacturing hub on Earth.
Because if you are a major manufacturer in, say, India, you suddenly have a really tough strategic choice.
Right. You can just keep your dirty operations and pay a massive recurring tariff directly to Brussels, meaning all that revenue leaves your country and goes straight into the EU's pocket.
Which no sovereign government wants.
Or, and this is the genius of the policy, your government can proactively set up its own domestic carbon market and tax you themselves.
Wait, so if India launches its own cap and trade system, and the Indian steelmaker pays a carbon tax directly to the Indian government, they can just deduct that exact amount from the EU border tariff.
Yes, perfectly stated. The EU will credit you for whatever carbon price you already paid locally.
So the tax revenue stays inside India.
Exactly. And this dynamic creates a massive, irresistible financial incentive for every developing nation on Earth to rapidly launch their own internal carbon markets just to defensively capture that tax revenue before Europe grabs it.
It is a legislative domino effect. CBAM is essentially forcing the entire global supply chain to finally put a hard price on carbon.
It is inescapable.
And when does this actually kick in? Because this isn't some distant 2050 goal, right?
No, this is happening right now. We're currently deeply into the mandatory data reporting phase. But the actual hard financial obligations, the massive cash payments at the border, begin in January 2026.
January 2026, that is basically tomorrow in corporate planning terms.
It is entirely imminent. If you are a CFO or you are working in global supply chain management right now, this should be a 5-alarm fire.
Because suddenly you don't just need to know the price of a steel beam.
You need to know the exact auditable carbon intensity of every single screw and beam you import from anywhere in the world. And you need to provision capital to pay for it.
Okay, so let's pull all these threads together. We have covered the basic mechanics of cap and trade, the absolute massive scale of the EU system, the portfolio investment thesis for hoarding allowances, the ongoing messiness of the voluntary market, and the absolute geopolitical sledgehammer that is CBAM.
We covered a lot of ground.
So what is the ultimate takeaway? So what for the listener who has been following this deep dive?
The primary takeaway is that carbon is simply no longer an environmental side quest. It is rapidly becoming the main economic storyline.
It is a pure market signal, and that signal is getting significantly louder every single quarter.
Right. If you are operating a business, it is a rapidly rising hard cost of goods sold. And as we saw with the shipping and building sectors, it is aggressively expanding its scope. You simply cannot afford to ignore it or treat it as just a PR exercise anymore.
And for the financial allocators?
For investors, it has evolved into a highly sophisticated, largely uncorrelated asset class. It offers genuine portfolio diversification, and it acts as a very specific mathematical hedge against the very regulatory transition that is currently threatening all of our traditional legacy industries.
And we are clearly seeing a massive convergence between these two parallel markets, right?
Yes, the walls are definitely starting to come down. The voluntary market is desperately trying to professionalize and standardize its auditing to look and feel much more like the strict compliance market.
Through things like Article 6.
Right. And simultaneously, the rigid compliance markets are slowly looking at ways to open up their borders to allow the very highest quality international removal credits into their systems.
So we are moving through a unified system.
A lot of analysts project that by maybe 2040, we might actually see a single, highly liquid, unified global clearing price for a ton of carbon.
Now, I want to end on a slightly philosophical note that came up right at the end of the research stack. It's a bit of a structural paradox.
Oh, it is the ultimate paradox of the entire carbon market concept.
Right. Because if this specific financial market is perfectly successful, if it does exactly what its architects designed it to do, it eventually completely destroys itself.
That is exactly the goal. You have to remember what we are fundamentally trading here. We are trading the legally mandated right to pollute.
Right.
If the cap and trade mechanism works and the price of that right gets high enough, corporations will aggressively innovate to avoid paying it. They will switch their fleets to hydrogen. They will install massive renewable grids. They will invent entirely new zero-carbon industrial processes.
It will completely stop emitting.
And if total industrial emissions go to true absolute zero across the economy,
the demand for carbon allowances instantly goes to zero.
And the entire trillion-dollar market completely evaporates overnight.
So as an investor, you aren't really buying a perpetual asset like gold or real estate. You are essentially investing in a temporary bridge.
Precisely. You are purely investing in a massive global transition mechanism. We desperately need this financial bridge to force society to cross the river to a post-carbon net zero economy.
But once we are safely on the other side of that river,
We don't need the bridge anymore. It becomes obsolete. But here is the critical point for investors. Crossing that river is going to take at least the next 30 volatile years, and it is going to inevitably generate trillions and trillions of dollars in newly created enterprise value along the way.
so we are buying into the journey, not the final destination.
And it is going to be an incredibly volatile, extremely lucrative, fascinating journey to watch unfold.
So the ultimate question for you, the listener, is really this. Look closely at your own portfolio. Look at your company's long-term operational strategy. Are you the one blindly paying the ever-increasing cost for the pollution? Or are you strategically positioned as the one holding the increasingly valuable permit?
That is the multi-trillion-dollar question right there.
Thanks for joining us on Talk Tickers. This has been The Deep Dive.
Thank you.